Good evening, all. Good evening, Rajesh bhai. Good evening,
Good
Ruta ma'am.
evening, Rohan sir. Good evening.
Rohan sir, good evening.
Hi, good evening. Good evening, everyone.
Good evening.
Yes. Welcome, the eminent faculty for today's session. Also, the chairman of Pune branch, C. Rajesh Agrawal, CA Ruta ma'am, regional council member, WRC, and all the participants for this 10 days international taxation refresher course. So, wherein we will be covering various aspects right from the basic sections of section 5, 6, 9, the residential status, permanent establishment, 15 CCB, and so on. So before we actually move on to the technical session, I would request Chairman Pune branch to give his welcome address.
Thank you, Pranav. Good evening to all the participants. Today's faculty, Rohan sir, Ruta madam, regional council member, Pranav Apte. Warm welcome to all of you. Actually, I really appreciate the efforts of Pranav for structuring this series, and definitely all the participants for joining this course on such a short notice. I believe after the completion of this series, you will be enlightened with many concepts of international taxation as well as transfer pricing. Thank you to all the faculties and participants for joining and supporting this course. Thank you, Pranav.
Thank you, sir. Ruta ma'am, would you like to have the welcome address?
Yeah, sure. Thank you so much. And why I actually wanted to see this, that last year I was also chairman of International Taxation Committee at WIRC, and I've seen firsthand that how much important this course is. So thank you, Pranav and Rajesh sir, for actually organizing this course, because not only in branches at like Pune, of course, Pune is now almost as equal to Mumbai, and also in terms of opportunities. And I think you have done a wonderful topics curated topics very well, and it's a bouquet of topics covering right from transfer pricing to individual taxation to how to handle even treaties and all such things. Really, congratulations for that. And I also wanted to say this, that we must as chartered accountants take this as a learning, irrespective of the fact that there is no CP. Let's not worry about it, because this is real capacity building in my opinion, and we must make full use of this. So international tax is definitely a way forward. And also in terms of official branches also, if we can propagate this course, it will be really helpful. So once again, congratulations Pune branch for taking up this course. Rohan sir, I'm looking forward to your session, because individual taxation is something of really, it is heart throbbing only, because there are so many complexities, and we don't know right now, but after 1 or 2 years, when people come and start asking questions, it becomes a real mess. So I'm really looking forward to your session today. Thanks, Rajesh, once again, and Pranav for this course. Bye.
Thank you, madam. Thanks a lot.
Thank you. Thank you so much.
Rohan sir, just like to add one point. We have participants not only from Pune, not only from Maharashtra, but across India. And some are the regular faculty, I must say, for the income tax sessions which we conduct.
Okay, nice.
Thank you. So I would like to welcome today's faculty, CA Rohan Umranikar. So I'll just briefly introduce him. Actually, needs no introduction, but I'll be failing in my duty if I don't do so. So today's faculty is a CA Rohan Umranikar, who holds a bachelor's degree in commerce and also master's degree in that is economics. He has been an All India rank holder in CA exams. He has more than 16 years of experience in handling corporate tax and international tax issues and business business restructurings, such as diverse disinvestments, fundings, mergers, acquisitions relating to multinational and domestic clients across a wide range of industries. He has also handled various issues relating to Indian foreign exchange regulations. He has presented clients at various stages of assessments and appeals. He has been a speaker and writer on tax topics at various forums such as ICAI, ICSI, CII, CTC, MCCIA, CREDI, HSBC, Tax Sutra, and EY. So welcome, Rohan sir.
Thank you. Thank you so much, Pranav, for the kind introduction.
And over to you. So the stage is yours.
Thank you. Thank you so much. Thank you to the Pune branch for giving me this opportunity to talk on this very interesting topic of individual international taxation. And I'm basically the opening batsman for this series. So I hope I live up to the expectations and set the course, set the tone for the entire course. Thank you, Rajesh sir, for inviting me, and Ata ma'am. Look forward to interacting with all the participants today, and I hope everyone joins in with their questions, observations, feedback as we move along. So I will be, in today's session, I'll be presenting on individual international taxation. We will start off with some of the basic concepts under the Income Tax Act, including the scope of taxable income, deemed accrual of income, TDS requirements under 195. We'll cover some basic treaty concepts as well, and then move to residential status, which is very important from an individual taxation perspective. So we will cover residential status under the Act as well as under tax treaties. And we will cover some case studies as we go along the way. So diving straight into the scope of taxation and TDS requirements under the Act. Basically, Section 4 of the Act is the charging section, which provides that income tax is leviable on the total income of any person, which is earned during the particular financial year or assessment year. And tax is to be charged at the applicable rate of tax. The important term here is the term total income, which is defined as the amount of income referred to in Section 5. So there's a specific definition, and it leads us to Section 5, where the scope of total income is defined. I've reproduced this section because this is a very crucial section in the entire scheme of taxation from a scope perspective. So the scope of total income as provided in Section 5 depends on the tax residential status of the person whose liability that we are talking about. So if you see this section, Section 5, it is divided into two subsections. Subsection 1, which deals with persons who are residents, and subsection 2, which deals with persons who are non-residents. When it comes to taxation of residents, basically the Act says that all income from whichever source derived, it may be received in India, it may be received outside India, it may accrue in India, it may accrue outside India. All income earned by a resident is taxable in India. There's a proviso to subsection 1, which says that if a person qualifies as a resident but not ordinarily resident, that is RNOR, then the income which accrues to him outside India will not be taxable in India. It will be taxable only if it is derived from a business controlled in or a profession set up in India. So that's a limited circumstance in which a person who is a resident but not ordinarily resident, RNOR as we commonly refer to, that person gets taxed in India. When it comes to taxability of a non-resident, basically income which is deemed to be received in India, or income which accrues or is deemed to accrue or arise in India, only that income is taxable. So the global income of a non-resident is not taxable. Only the India sourced income or the India received income is taxable in India. That's the important distinction that we have to draw when it comes to scope of taxation. So to summarize, for a ROR, RNOR as well as NR, India sourced income, that is income which accrues in India or is deemed to accrue in India, that is taxable in all three cases. Income which is received or deemed to be received in India, again here the first receipt is important, subsequent remittance doesn't matter. So if a person receives, let's say, capital gains, a non-resident receives capital gains in his foreign bank account and then he remits something to India, to his relatives, that is not taxable in India. The first receipt is important. And the third category is where income accrues or arises or is deemed to accrue or arise outside India. So here only a resident and ordinarily resident is taxable for this category of income. RNOR as well as NR, they are not taxable in respect of income that accrues outside India. Now here, if we observe, the two terms that are used are income accruing or arising in India and income deemed to accrue or arise in India. Now, the concept of accrual is something that has to be tested for each stream of income and based on case laws and the general meaning of the term accrual. But the Act does provide for a deeming fiction. The deemed accrual concept is defined in Section 9 of the Income Tax Act. And we will cover certain important streams of income which are relevant from an individual perspective. So the first stream of income under Section 9, which is relevant from an individual perspective, is salary income. The condition for deeming salary income to be accruing in India is that the services have to be rendered in India. So if there is an employee of a foreign company who usually works, let's say in the US where he is employed, but he comes to India for a project and he works in India and he receives salary income outside India in, let's say, his US bank account, that income is also deemed to accrue in India because his services are rendered in India. He's physically present in India while rendering those services. So under the deemed accrual concept, this becomes part of his taxable income. Of course, it is subject to tax treaty relief if the US treaty so provides, which we will cover in the subsequent slides. The next important stream of income will be royalty and fees for technical services, also interest on any borrowings. There's a specific source rule, which I've covered in the subsequent slide, and we'll come to that. Business income, any income which accrues from a business connection, that becomes taxable in India under the deemed accrual concept. Business connection, again, is not a term which is defined. It's defined in a very wide manner. And typically, judicial precedents have interpreted this also in a very wide manner. So if there is a business connection in India, that income becomes taxable in India under the deemed accrual concept. There's a parallel concept of a permanent establishment in tax treaties, where as compared to the term business connection, a slightly narrower meaning or a defined term is given for interpreting permanent establishment, and that usually turns out to be beneficial as compared to the business connection terminology. The next stream of income is capital gains. For capital gains, if the non-resident or anyone is transferring a capital asset which is situated in India, then that income is deemed to accrue or arise in India. So if a US resident, for example, transfers shares of an Indian company, then the shares of the Indian company are situated in India as held by Vodafone and a lot of other precedents as well. And hence, that income, the capital gains, will be deemed to accrue in India and hence will be taxable in India, again subject to treaty relief. For dividends, again, if it is paid by an Indian company, it is deemed to accrue in India. So these are the 5 or 6 key income streams which an individual typically would receive from India. And we have to always test accrual independently under Section 5 and deemed accrual under Section 9 independently, and see if the income falls within the ambit of Section 5 or Section 9 and hence becomes taxable in India under the domestic law provisions first. A question that can come up is, can fees for technical services which do not fall within the ambit of Section 917, which is specific to FTS, be taxed under Section 911, which is income accruing from a business connection? So let's take a case where a non-resident, let's say an engineer, an individual who is an engineer, renders services to an Indian company, and he has been doing it through an agent on a regular basis. Now, the question that comes up is this particular technical service fee, if it doesn't fall within Section 917, let's say it's in connection with a construction project for which there is a specific exemption carved out under 917. Will that be taxed under Section 911 on the basis that the engineer has a business connection in India? Now, there are High Court level judgments which have said that once a particular stream of income is tested for FTS, which is a more specific provision as compared to the general provision of business income, then, and if you find that it is not taxable under FTS, then you can't have recourse to the general provision, which is to do with business connection. And hence it should not be taxable in India. Coming to the FTS and royalty source rule, it basically says that if royalty or fees for technical services are paid by the government of India, then in all cases it is deemed to accrue or arise in India. If the fees for technical services or royalty is paid by a resident, then again it is deemed to accrue or arise in India, unless it falls in it basically meets the conditions, any of the two conditions which are mentioned on the slide. So the first exclusion is where the services are utilized for the purpose of carrying on a business or profession outside India. So let's take an example. There's an Indian company which has a branch outside India, and it makes payments for certain services that it wants to avail at its branch. In that case, basically one can say that there is a business or a source of income for the Indian payer company which is outside India, and the services are also utilized by that branch. In that case, the source rule exclusion, as we typically call it, that applies, and hence even though the payment is made by a resident of India to a non-resident, it doesn't qualify as income accruing or deemed to accrue in India. If we consider payments by non-residents, so if, for example, a non-resident company makes a payment to another non-resident, it will typically not be deemed to accrue or arise in India unless the non-resident payer is making that payment for services which are utilized by the non-resident for carrying on a business in India, or it is utilized for making or earning any income from any source in India. So the exact opposite applies to a non-resident. If a non-resident makes payment to another non-resident, it's typically outside the tax purview. Only in certain exceptional situations, it becomes deemed to accrue or arise in India. Let's understand this with a couple of case studies. The first case study is where, let's say there's XYZ, a company in India, which is making payment to Mr. X, who is based out of BVI. India doesn't have a tax treaty with BVI. And hence we have to basically analyze this payment under the Income Tax Act. Now, XYZ utilizes these services in its SEZ unit. So the SEZ unit is 100%, has 100% export turnover. It doesn't have any domestic turnover. The question that can come up here is whether the payment made by XYZ to Mr. X will be taxable in India, or can it be said that XYZ has made this payment for the purpose of earning income from a source which is outside India, because this service is used by its SEZ unit, which only has export turnover. It has only overseas customers. It doesn't have any domestic customers. So can we avail the source rule exemption provided under the Income Tax Act itself and say that this payment is not taxable in India? If we analyze this, and there are judicial precedents on this source rule exclusion in the context where the Indian company makes payment for export sales. If we analyze these decisions, the decisions basically say that we have to look at the meaning of the term source. And source is interpreted as the starting point or origin from which something springs into existence. So the income has to be, so the source and the income have to be linked. Right. So what is the source of the income? Is the customer your source of income, or is the business activity your source of income? That is the key test that one needs to answer. And the decisions basically say that customer typically cannot be regarded as the source of income. The business operations and activities which trigger the exports, all of those activities take place in India, which is the source of income. And hence, the exclusion clause under section 917B will not apply in this case. So there are precedents of the Delhi High Court. There's an advance ruling and tribunal rulings as well, which support this view. On the other hand, there are contrary decisions of the Madras High Court and Delhi High Court as well, where it has been held that if it's a 100% export unit, then the source is outside India. So there are conflicting judgments on this particular point, but in my personal view, the better view would be that this is not covered by the source exclusion. Let's take another case study. So XYZ, an Indian company, again makes payment to Mr. X. He is a BVI resident, but this time it is used. The services are utilized for the purpose of XYZ's branch in Spain. So here the key difference is that XYZ is not using it in its manufacturing activities which are situated in India. The services are going to be utilized by its branch. In that case, will Mr. X be liable to pay tax in India under the provisions of the Act? So here the situation is different. Here, basically the source of income is the branch's activities, which are completely outside India. And hence here, there's a better argument that the source rule exclusion should apply. And hence the remittance which is made by XYZ to Mr. X should not be taxable in India. And there are precedents also saying that this source rule exclusion can apply in respect of a prospective or a future source of income as well. So the branch at Spain, even if XYZ has plans to set up a branch at Spain and hence is utilizing certain services, even that can be covered under the source rule exclusion. Moving on to section 195, which basically says that whenever a resident is making payment to a non-resident, then there has to be a tax deduction at source in certain cases if certain conditions are satisfied. So it basically applies to payment to any non-resident, not being a company or to a foreign company. Thus, it covers payments to a non-resident individual as well. However, RNOR is not covered. So if a resident individual makes payment to a resident but not ordinarily resident, 195 doesn't apply. The other provisions dealing with TDS, which are applicable to resident taxpayers, one will need to test the TDS applicability under those provisions. RNOR is not covered. Basically, there's a definition of non-resident under the Act, and it includes RNOR only for certain specific sections. It doesn't include RNOR for the purposes of section 195. There are certain payments which are subject to 195. So these are payment of interest other than certain specific interest streams like those taxable under 194 LC, LD, which are taxable at a 5% tax rate, or any other sum chargeable under the provisions of the Act not being salary income. So typically any payments to non-residents will get covered under 195. Salary income remains, it is covered under 192. So 192 applies to both resident employees as well as non-resident employees. Tax has to be deducted at the time of credit of income to the account of the payee or at the time of payment, whichever is earlier. And tax has to be deducted at the rates in force, which is basically the rate specified under the Act. There are certain special rates for specific income streams like FTS, royalties, interest, and so on, or the relevant tax treaties. So again, tax treaties will have concessional rates typically as compared to the domestic law, and those rates can be applied while deducting tax under section 195. So whichever provision is more beneficial to the non-resident taxpayer, one can avail that that provision either under the domestic law or the treaty, and tax can be deducted at that rate. Again, when it comes to applying the tax rate, surcharge and education cess is typically subsumed within the tax treaty rate, because the definition of tax under the tax treaty typically covers income tax as well as surcharge. And there is a Supreme Court judgment which basically says that even education cess is an additional surcharge, and hence it should cover tax, surcharge, and cess typically. Then under section 195, there is a reporting requirement in form 15CA, 15CB. So for every remittance, one needs to file 15CA and get a CA certificate. There are certain transactions where you don't need to submit form 15CB, but practically bankers typically insist for form 15CB in all overseas remittances, notwithstanding the fact that under Part D you can make the filing without the need to get a CA certificate. There's also a provision to apply for and obtain a lower withholding tax certificate from the tax authority. So whenever you are in doubt as to what tax rate should be applied, or if the non-resident is taxable on a net income basis, and as a resident you don't know, or you can't you don't want to basically take any risk in terms of the tax authority subsequently coming after you for not complying with the TDS provisions. It's always advisable that you approach the tax authorities and get a lower tax deduction certificate so that you can then apply that TDS while making the overseas remittances. Also, another point to note here is that in the case of GE India Technology Center, the Supreme Court has held that TDS is not required if a payment is not taxable in India, either under the Income Tax Act or the tax treaty. So the payment in that case was software licensing, where there are recent judgments as well, which have held that subject to, of course, the correct documentation being maintained, those payments are not taxable in India. So this analogy can be applied to any income stream. Basically, if the payment to a non-resident is not taxable, then you don't need to deduct tax under 195. That is how this any other sum chargeable under the provisions of the Act, this term has been interpreted, and the Supreme Court has said that no need to deduct taxes. So the key takeaway here is that whenever you're reviewing a particular payment to a non-resident, basically you need to review taxability under the Act as well as under the treaty, and make sure that the position is correct in terms of the tax rate as well as the taxability of the payment. If you have any doubts, it's always advisable to either go for an advance ruling or go to the tax authorities and get a lower tax certificate, or then conservatively deduct taxes. It also happens that in some cases, there's a net of tax contract. So the Indian resident payer is supposed to bear the tax liability of the non-resident in case there is a tax liability in India, in which case that's an additional burden on the resident payer. So in those cases, you have to be careful in terms of the provisions and see if there is any planning option available in terms of either lowering the tax rate or taking a position based on interpretation of the treaty that the payment is not taxable in India. I'll take a pause here in case anyone has any questions. Happy to address those now or towards the end of the session.
Sir, we will take at the end of the session.
Okay, sure. So moving on to basics of tax treaties, we will cover just the key concepts which are relevant while interpreting tax treaties and getting to know what all concepts are covered in tax treaties. How do we need to interpret those? So first of all, what's a tax treaty? It's basically a bilateral arrangement between countries where two countries come together, negotiate the taxing rights, and based on that, the country of residence of the taxpayer and the country of source, that is the country from which the income is derived, they agree on the taxing rights. That's typically the nature of a tax treaty. Now, while typically all treaties are bilateral arrangements, there can also be multilateral arrangements. And we have seen a recent example in the form of the multilateral instrument, which got executed as part of the base erosion and profit shifting action plan of the OECD. The preamble to the treaty indicates the objective of entering into the treaty. Typically, it is for avoiding double taxation, but it can also be for prevention of tax evasion, exchange of information and mutual assistance between taxing jurisdictions, and for encouragement of mutual trade and investment. Certain treaties have this explicit object mentioned in the preamble, that one of the objects of the treaty is to encourage investments in the other country. So with Singapore, for example, we have the Economic Cooperation Agreement. And there it has been clearly mentioned that this is to encourage mutual investments. Again, under the Base Erosion and Profit Shifting Action Plan, the purpose of the treaty is both to eliminate double taxation and also prevent double non-taxation. Because as part of the BEPS action plan, the emphasis is on preventing double non-taxation, where basically taxpayers take advantage of treaty shopping and other means to reduce their tax base. And there is a mandatory action plan in the BEPS action plan, which says that the preamble to the tax treaty should have this specific amendment, which says that double non-taxation should not be promoted. There are typically two tax systems, as we discussed, the residence-based tax system and the source-based tax system. In the residence-based tax system, the connecting factor is residence of the taxpayer with the home country. And it's a generally accepted norm that the country of residence has the primary jurisdiction to tax. So the country of residence will tax the entire income, the global income of the taxpayer. And if there is a conflict on the residential status, so if, for example, two countries say that this particular taxpayer is a resident of both the countries, then there's a tiebreaker test prescribed in the treaty, which then takes care of the residential status of the taxpayer. The second system is the source-based tax system. And here the connecting factor is income. So basically, where does the income arise or accrue? That is the country of source. And the country of source then has a right to tax the income in certain specific situations, which are defined in the tax treaty. Typically, double taxation occurs where country of residence and the country of source seek to tax the same income. So in these cases, in order to prevent double taxation, treaties provide certain relief. They can either provide relief by allocating taxing rights to only one of the two countries, or then providing a mechanism whereby the country of residence of the taxpayer typically gives a credit for the taxes paid in the country of source. So while this is a way to reduce your double taxation, it doesn't really ensure in all cases that you don't end up with a higher tax burden, because the source country may have a higher tax rate, or it may tax the income on a gross basis, whereas the residence country may tax on a net basis, and there may be some additional tax cost because of the way the source and the residence country tax the income. There are typically three models under which tax treaties are entered into. The first model is the model which is prescribed by the Organization of Economic Cooperation and Development, the OECD model. Typically, this is preferred by developed countries because it gives more right to tax based on the residence principle. Then there's the United Nations model, the UN model, which gives right to tax based on the source principle and is generally preferred by developing countries, including India. Because let's say till about 10-15 years back, India had a lot more inbound investments as compared to outbound investments, in which case we were always the source country, and hence any model which gives the source country the right to tax the income, that was always preferred, and hence India always preferred the UN model. The third model is the US model, which is specific to how US negotiates its tax treaties. So India has followed a combination of OECD and UN models, but there's a lot more emphasis in Indian tax treaties on source taxation. How does the treaty interplay with the domestic law? There's a particular section in the Income Tax Act, section 90, subsection 2, which clearly provides that the taxpayer can opt for taxation in accordance with the tax treaty or domestic tax laws, whichever is more beneficial. And we've seen that domestic law provisions can at times be more beneficial. For example, tax rate on interest income, if it meets certain conditions, then under the domestic law, it's 5%, whereas under the treaty, it can be 10 or 15% as well. So there, typically, the non-resident will choose to be governed by the domestic law of India as opposed to the tax treaty. There can be question as to how this provision can be applied where the non-resident derives multiple sources of income in the same financial year. So let's take an example. The first example is where the non-resident earns royalties as well as interest from a taxpayer. In this case, typically the royalty tax rate under the treaty is 10% or 15%, whereas under the Act, next year onwards, it's going to be, or rather this year, financial year onwards, it is 20%. So here the non-resident will typically prefer the withholding rate as per the treaty. At the same time, is also earning interest income, where the domestic law provides for a 5% tax rate, whereas the treaty would typically provide 10 or 15%. So here he can choose to be governed under the domestic law. So a non-resident earning two different sources of income, for one source of income, he can apply the treaty rate. For the other source, he can apply the domestic rate. There's a specific precedent where this has been upheld, which is the case of Morgan Stanley. Then there can be different contracts as well that a non-resident enters into with Indian companies. Again, here for contract one, which is the same type of income that is earning from contract one, he can choose to be governed by the domestic law. And for contract two, he can choose to be governed by the treaty. Again, there's a precedent which allows this. There can be a scenario where there are two streams of income under the same contract. Again, for the same contract as well, as long as there are two distinct streams of income, we can again choose to be governed by the treaty for a particular stream of income and the act for the other stream of income. An important point to note here is that tax treaties do not create any additional tax burden. They basically alleviate the taxes. They can't really create taxes where none exist under the domestic law. How do we interpret tax treaties? So from an interpretation perspective, basically what we need to keep in mind is that tax treaties and domestic law or domestic legislation is not at par, because the treaties are negotiated at a political level by diplomats. They don't really use very legal language. There are a lot of terms which are not defined in tax treaties, whereas under the domestic law, you'll find that most of the terms are defined. So what we need to keep in mind while interpreting tax treaties is the object and purpose of the treaty, and make sure that whenever we are interpreting any treaty term or a treaty language, we keep in mind that it meets the primary purpose of the tax treaty. So towards this, there are certain aids of interpretation, and the Vienna Convention on the law of treaties is something which all countries refer to when it comes to interpreting tax laws. The Vienna Convention on the law of treaties is not really a tax agreement between countries. It's basically a treaty on treaties. It states how countries should draft tax treaties, how they should interpret tax treaties, what should be the procedures under any treaty for that matter. And it codifies existing norms of customary international law with some necessary gap filling and clarifications. So it typically applies to all international treaties, including tax treaties, not just restricted to tax treaties. In the context of tax framework and tax interpretation, there is a Supreme Court judgment in the case of Ram Jethmalani in the Indian context, which has said that Vienna Convention basically codifies customary international law, and the principles of interpretation given under Vienna Convention, especially Article 31(1), gives a good guiding light in terms of how treaties should be interpreted even under the Indian context. Also, there's a judgment of the International Court of Justice, which is basically the UN organ, and the ICJ also says that the Vienna Convention should be followed by all countries, irrespective of whether they are signatories to the Vienna Convention. So India is not actually a signatory to the Vienna Convention. It has been ratified by almost 120 countries all across the world. But even countries who are not signatories to the Vienna Convention should ideally follow the interpretation rules given in the Vienna Convention. On the slide, you'll see some key articles of VCLT, which are important in terms of treaty interpretation. So Article 26 says that every treaty in force is binding upon the parties to it and must be performed by them in good faith. Article 31(1) says that a treaty should be interpreted in good faith in accordance with the ordinary meaning to be given to the terms of the treaty in their context and in the light of its object and purpose. So this is again to make sure that countries do not unilaterally change the meaning of certain terms or interpret the language as per their domestic law, when actually while negotiating a treaty, a different context was decided for that particular term or for that particular language. In Article 31(2) says that context is defined to include text and subsequent agreements, instruments related to the treaty. 31(4) says that special meaning is permitted only if it is specifically intended by the parties. Article 32 says that supplementary means should be used only to confirm the meaning of a particular term. And Article 34 says that a treaty does not create either obligations or rights for a third state without its consent. So basically, keeping in spirit the bilateral nature of most of the treaties, a third state should not be impacted because of the bilateral arrangement between two countries. Then if we come to the domestic law as an aid to interpretation, there is a specific article under the OECD as well as UN model commentary, which says that as regards the application of the convention at any time by a contracting state, any term which is not defined in the treaty, unless the context otherwise requires, it shall have the meaning that it has at that time under the law of that state for the purpose of taxes to which the convention applies. What does this mean? It basically means that if a term is not defined in the treaty, then recourse can be made to the definition of the term under the domestic law, which is prevailing at that point of time. So there is a debate as to whether a definition which comes in or is introduced in the domestic law, let's say 20 years after the treaty was entered into, can this particular meaning be used for the purposes of the tax treaty, because that meaning was never in the legislation when the treaty got agreed. So here there's a debate on static versus ambulatory meaning of the term. Static meaning means that the definition is static. It has to be looked at the point of time when the treaty was entered into. Ambulatory means that the definition can keep changing. So if the definition changes, you apply the changed meaning while interpreting the tax treaty. And there are precedents which have held or have upheld both the approaches. The prevailing popular view, including that of the OECD and the way the language has been amended, it basically prefers the ambulatory approach, which basically means that if a term is defined in the domestic law and it keeps changing over a period of time, the changed meaning has to be looked at. Of course, there's an exception that it has to fit the context and it should not be radically different from what was agreed informally or through other means when the treaty was entered into. Then we also have the OECD commentary and the UN commentary, which basically elaborate in terms of the treaty, in terms of the language used in the model convention. And the relevance is that most of the treaties, as we discussed, are based on either the OECD or the UN model. So they borrow the language which is covered in the OECD model convention or the UN model convention. And hence, does the model commentary, which is given by the OECD or the UN, have any value when it comes to interpreting the language used in the model convention? So what does the OECD commentary say about its significance? It basically says that member countries should conform to this model convention as interpreted by the commentaries thereon, and their tax authorities should follow these commentaries as modified from time to time and subject to their observations thereon when applying and interpreting the provisions of their bilateral tax conventions that are based on the model convention. So the OECD model basically encourages tax authorities to follow these commentaries as long as the language is used is based on the model convention. It also goes on to say that the worldwide recognition of the provisions of the model convention and their incorporation into a majority of bilateral conventions have helped make the commentaries a widely accepted guide to interpretation and application of provisions of existing bilateral conventions, which has facilitated interpretation and enforcement of these bilateral conventions along common lines. So this is another way in which the model commentary also helps, because if there is consistency in interpretation by both the countries, then that gives more certainty to taxpayers as well. So this is basically what the OECD model commentary says. When we come to the UN model commentary, it says that like all model conventions, the UN model convention is not enforceable. Its provisions are not binding. If the negotiating parties decide to use in a treaty wording suggested in the UN model convention, it is presumed that they would also expect to derive assistance in the interpretation of that wording from the relevant commentary. The commentaries which may prove to be very useful in the implementation of a treaty are not intended to be annexed to such a treaty, and the text of the treaty would constitute the legally binding agreement. So what this basically means is that while the model commentary will have some persuasive value while interpreting the tax treaty, if it is based on that particular model convention, it's not legally binding. And if we come to the Indian context, there are precedents where courts have followed, in some cases, the model commentary. In some cases, they have disapproved, relying on the model commentary as well. So from an Indian perspective, I would think that the commentary definitely carries persuasive value, but we have to be mindful of the observations of India while reading the OECD model commentary or the UN model commentary. And it's not that the courts will blindly rely on the model commentaries when it comes to interpreting tax treaties. With that, let's move to the concept of residential status under Section 6 and Article 4 of tax treaties. We'll first cover residential status under the Income Tax Act. So under the Income Tax Act, residential status of an individual is based on the physical presence in India. There are certain basic conditions that one needs to meet in order to qualify as a resident. And there are certain additional conditions. If those conditions are met, then the person becomes resident and ordinarily resident, or RNOR as the case may be. So let's first look at the basic conditions. If the individual is present in India for at least 182 days during the tax year, then he becomes a resident. The other condition, alternate condition, is that the individual is present in India for at least 60 days during the tax year and 365 days during the 4 years immediately preceding the tax year. So you have to look at 5 years, 60 days during this tax year, 4 years back. You have to go 4 years back, add the days, and see if the person was in India for more than 365 days. If any of these two conditions are met, then the person becomes a resident of India. If both the conditions are not met, then the person becomes a non-resident. This 60-day threshold is relaxed for persons of Indian origin and Indian citizens, which we will cover in the subsequent slide. Then there are a couple of additional conditions. The first additional condition is that the individual is a non-resident in India in 9 out of 10 tax years preceding the relevant tax year. The second condition is that the individual is present in India for 729 days or less during a period of 7 tax years preceding the relevant tax year. So if any one of these two conditions is met, the additional conditions is met, then even if the person is a resident, he qualifies as a RNOR. And if none of the conditions are met, additional conditions are met, then the person becomes a ROR. And as we discussed, the scope of taxable income is different for ROR and RNOR. So it's always beneficial to qualify as RNOR. There are certain special rules for Indian citizens and persons of Indian origin. So the first relaxation is in the case of an individual who is a citizen of India and he leaves India as a member of the crew of an Indian ship or for the purpose of employment outside India. So if any of these two scenarios are met, then the 60-day threshold is extended to 182 days. So if tomorrow I go out for the purpose of employment with a US company and I have stayed in India for 130 days, I will still qualify as a non-resident. The 60-day threshold is increased to 182. In the case of an individual who is a citizen of India or a person of Indian origin, who being outside India comes on a visit to India, again the 60-day threshold is extended to 182 days. So the second relaxation applies to both citizens as well as persons of Indian origin. And a person of Indian origin is defined under Section 115C of the Income Tax Act to mean a person, either he or his parents or any of his grandparents were born in undivided India. In that case, the person qualifies as a PIO. Now, the first relaxation, basically, which is for the purpose of employment outside India, there are precedents which have interpreted this to mean that if a person is going outside India on a tour or an assignment while working for an Indian company, then this exclusion doesn't apply or this relaxation doesn't apply. It only applies if he is leaving India for the purpose of employment outside India, which means that he should be employed by a foreign company. And in those precedents, there is a distinction drawn between the term for the purpose of employment and in connection with employment. So if you continue to be employed with an Indian company, but move outside India during the financial year for any project, then this relaxation is not likely to apply. In terms of the second relaxation, which is for visits to India, if we look at the legislative history of this particular provision, in the initial days until 1982, this particular relaxation was given only if the person was coming back on a vacation or on leave. In 1982, this was extended to cover visits to India. And if you look at the finance minister's speech, the FM basically said that this benefit of visits to India is being extended to even self-employed people, because till then only employed people could take this benefit. So it's being extended to self-employed people and without any restriction on the nature of activities that can be done when they are coming back to India on a visit. So basically now you don't need to look at the purpose for which the person is coming back to India on a visit. As long as he's based outside India and is coming on a visit to India, this threshold, the 60-day threshold, stands relaxed to 182 days. The important thing is that you need to substantiate that the person is actually based outside India. It's not the other way around, that is based in India and is going on a visit outside India. He's actually based outside India. So for example, he may be residing with his family outside India and is coming on a few visits to India, let's say to visit his parents. In those situations, this threshold will get extended to 182 days. Now here, a couple of years back, an amendment was introduced to say that if such an individual stays in India for 120 days or more, but up to 181 days, he will be considered as a RNOR, provided his India sourced income exceeds 15 lakh rupees. How do we compute the physical presence in India? Now, this is a very critical element when it comes to establishing residence in India, but unfortunately, we don't have any specific rules in the Act to decide how the computation should be done. So we have to rely on the OECD model commentary or on judicial precedents, which have elaborated the meaning of this particular computation. As per the OECD model commentary, even a part of a day or the day of arrival, the day of departure, holidays, all of these days are to be included when computing the physical presence in a particular country. In a few judicial precedents, some of these elements have been relaxed. So for example, in the case of Gautam Banerjee, the Mumbai Act held that the date of departure should be excluded. But it should be borne in mind that this was based on the specific facts of that particular case. In this case, this particular individual was supposed to travel to the US. He reached the airport before midnight, but his passport was, I think the immigration checks, etc., all of that happened after midnight. And that's the reason why if that day was counted, the day starting after midnight, then he would have stayed in India for 182 days. In that particular fact pattern, court held that the day of departure after midnight should be excluded. In the case of Manoj Kumar Reddy, the Karnataka High Court held that the day of arrival should be excluded because it's only part of the day. A similar view has been upheld in the Mumbai ITAT decision as well. But there's a negative or a conflicting judgment of the advanced ruling authority as well, which supports the view that the arrival date should be included. I think from a planning perspective, one should be conservative and plan that all days, be it the day of arrival, day of departure, partial day visit in India, all of those days should be included while planning for this particular threshold, the 120-day threshold or the 182-day threshold. Deemed residency for stateless persons, again, this is an important provision which was introduced a couple of years back, Section 6(1)(a) of the Act, which basically states that in certain situations, a person who is a citizen of India will be deemed to be a resident of India as well, and will go through the conditions. So the first condition is that it applies only to Indian citizens, doesn't apply to a person of Indian origin. The second condition is that the India sourced income of the individual should exceed 15 lakh rupees. And the third condition is that the person should not be liable to tax in any other country by reason of domicile or residence or any other criteria of a similar nature. And the term liable to tax has been specifically defined in the Income Tax Act. It means that there is an income tax liability on such person under the law of that country for the time being in force, and shall include a person who has subsequently been exempted from such liability under the law of that country. So let's take an example. There's an Indian resident who goes to UAE, goes to Dubai for employment. Now he has some investments in India which yield him, let's say, INR 15 lakhs during the year. And the question, the key question that comes up is whether he is liable to tax in UAE by reason of domicile or residence. There were quite a few rulings in the context of liable to tax, which said when a person has moved to UAE, is liable to tax in UAE. There need not be a liability in present. It can be a future liability as well, which will be covered under the term liable to tax. And it should be distinguished from the term subject to tax. So liable to tax can cover future liability. Subject to tax is present liability or actual liability. Now, with the term, with the meaning or the definition being introduced in the Income Tax Act, which basically says that there has to be an income tax liability on the person under the law in that country for the time being in force. It is unlikely that a UAE resident or a person who goes to UAE will be considered as liable to tax in UAE under the under Section 229A. Given that UAE does not impose any tax liability on individuals deriving income from salaries, etc. So in this case, in this situation, this particular individual will trigger the conditions for a deemed residency in India. And the Act says that, again, the duration is not relevant. Even if you have not stayed for a single day in India, you will still be regarded as a deemed resident of India. The only saving grace is that you are treated as a RNOR. So your UAE salary, for example, in this case, does not become taxable in India because it is not accruing in India or is not deemed to accrue in India. But you are treated as RNOR. And hence the other provisions which apply to residents will apply even to such an individual. So what could be the impact areas? Because typically, again, whether you are a RNOR or NR, your overseas income is not taxable in India. So the question is, what are the consequences? One of the key consequences is in the context of promoters. We've seen a lot of promoters actually shifting their base, especially after COVID, shifting to UAE or other countries, let's say Singapore, UAE, and other countries. If a promoter, for example, shifts to UAE and he's regarded as a RNOR under Section 61A, and if he wants to sell the shares of his Indian company, he wants to exit from his India business, then if he had qualified as a non-resident, he would have been liable to pay tax at 10% under 112(1)(c) of the Act. Now that he qualifies as RNOR, the special rate of tax, the 10% tax rate, is applicable only to non-residents. It is not applicable to RNOR. And RNOR is fundamentally a category of residents. It's not a category of non-residents. And hence he will not be eligible to claim the 10% tax rate if he's selling shares of an Indian company. Also, the other point to be borne in mind is that such a promoter may, through a divestment of his other investments, plan that his India sourced income year on year is less than 15 lakhs. But again, this may not really work in the context of an exit from an India business eventually, because when he sells shares of the Indian company, his India sourced income automatically will exceed 15 lakhs. So again, he has to plan his affairs in a better manner in case he wants to qualify as a non-resident. So this is a flowchart in terms of understanding the residential status. I mean, we've discussed this and we'll skip this. Let's come to the case study on employment outside India. So the fact pattern is such Mr. X is an Indian citizen. He leaves India in August 2021 for the purpose of employment in Singapore. His physical presence in India during FY 21-22 is 132 days, and during 22-23 it is 121 days. Assuming he has India sourced income in excess of 15 lakhs in 21-22 as well as 22-23, what will be his residential status for the 2 financial years? And if he takes up employment in UAE instead of Singapore, will it impact his residential status for either financial year? Now, if we look at the residential status for FY 21-22 first. FY 21-22 is when he has moved, he has left India for the purpose of employment outside India in Singapore. So, as per the first relaxation provided under Section 6, since his physical presence is less than 182 days, he will qualify as a non-resident. In the subsequent year, let's take 22-23. He is physically present in India for 121 days. Now, the employment related relaxation applies only in the year when he leaves India for the purpose of employment. It doesn't apply in the subsequent years. That's how judicial precedents have interpreted the relaxation. So, in the subsequent year, FY 22-23, we have to consider the relaxation with respect to visits to India. And there is an amendment which says that if the physical presence exceeds 120 days, or rather 119 days, then the person will be regarded as RNOR. So for FY 22-23, his residential status will be RNOR, since he has crossed 120 days of physical stay in India. If he takes up employment in UAE instead of Singapore, in the first year itself, FY 21-22, although his physical presence in India is less than 182 days, as we discussed, he may not be considered as liable to tax in UAE. And the moment he is not liable to tax in UAE and has income in excess of 15 lakhs in India, he will be deemed to be a resident, RNOR, under Section 6(1)(a). So his status basically will be RNOR for FY 21-22 as well as RNOR for FY 22-23. Moving on to the concept of residency under the tax treaties. This is again, as we discussed, a crucial condition to satisfy. Even under the tax treaties, basically, in order to avail tax treaty, you have to be a resident of either of the contracting states. Otherwise, you can't really access the tax treaty. This condition is clearly mentioned generally in Article 1, which is the scope of the tax treaty. It says that treaty applies to persons who are residents of one or both the countries. Then Article 4 typically defines the residential status of a person. It typically says that a person is a resident of a country if he is liable to tax in the country by virtue of domicile, residence, place of management, or any other criteria of a similar nature. And if the individual is resident of both the countries, then the tiebreaker rule determines the residency. So again, the key term here is liable to tax on account of domicile residence in the context of an individual. Moving ahead to the tiebreaker test under the tax treaty. These are the 5 tests that need to be applied sequentially in order to break the tie, either in favor of state A or state B. These are the typical tests that are there in almost all the treaties. So the first test when it comes to the tiebreaker rule is the test of permanent home. Person is deemed to be a resident of the state in which he has a permanent home available to him. If he has a permanent home available to him in both the states, then he is deemed to be a resident of the state with which he has his personal and economic relations, or the center of vital interests. The third test is habitual abode. If the state in which he has his center of vital interest, it cannot be determined, or if he doesn't have a permanent home in either of the states, then you come to the habitual abode test and see where is he habitually residing. Then that state becomes the state of residence. If none of these 3 tests work in the context of a particular individual, you should check his nationality. and whichever country that he is a national of, that country becomes the state of residence. If all tests fail, then the tie has to be decided through a mutual agreement between the competent authorities of the two contracting states. It should be noted that all treaties do not have this tiebreaker clause. For example, the India-Japan treaty doesn't have this tiebreaker clause. But in most of the treaties, you will find a similar kind of a tiebreaker clause. What do you mean by a permanent home? Does it only mean an owned property, or does it also cover rented accommodation? According to commentaries and judicial precedents, it can cover any form of home. It doesn't need to be owned. Ownership is not really a test. It can also be a rented premise, or it can be provided by the employer of the individual. The only condition is that it has to be available to the individual on a continuous basis. So if he tomorrow wishes to go and reside in that home, it should be available. It should not be under any encumbrance, or it should be a temporary accommodation and for a short duration or an occasional stay. It should be continuously available to the individual. On the flip side, if the person is owning a house, but if that house is given on rent to a third party, such that the owner cannot go and access the house during that period, then even though the person owns that house, it can't be regarded as a permanent home available to him. The length of the individual stay in that home is not really of any consequence. The only test is that it has to be available to him. So the test of disposition is important when it comes to assessing the availability of a permanent home. The next test is the center of vital interest, and this is very factual and subjective. Basically, it is to be applied only when the person has a permanent home available in both the states. So this test has to be applied in that context. So whichever home, in whichever state, the vital interests of the individual are more closer, that is the state in which he will tie break into. The OECD commentary specifies a number of factors to be considered when it comes to deciding the center of vital interest. So it can be where the family is situated, does he make political contributions in a particular country, where are his assets located, where is his employment, and so on. So all these factors have to be weighed when it comes to deciding the center of vital interest. And the most significant factor in establishing to which state an individual's personal relations are closer is where he regularly lives with his family, which is very logical. Also, one must not only count the number of connecting factors, but gauge the depth or the importance to the individual in respect of each connecting factor. It can so happen that the economic relations of a particular individual are with state X, but his family is residing in state Y. And that is of such a crucial importance that he keeps coming back to his family, and he eventually also has an intention to stay with his family in state Y, and so on. So if all these factors are compared and weighed, and if the personal relations are closer with state Y, that is the state in which he will break into based on the center of vital interest. But again, the important thing to note here is that this is very, very highly subjective, highly factual. And also one more point to note is that while the tests are to be applied sequentially, and ideally you need to stop wherever you meet a particular test. In the Indian context, there are precedents where even though the courts have said that a particular individual has a center of vital interest in state X, they've gone on to also test the subsequent test, which is the habitual abode test. Let's look at the next case study, which is in the context of a resident and not ordinarily resident. And in the context of treaty benefits, is he eligible for treaty benefits, and what can be the controversies around this? So if we look at the different types of definitions of resident under the tax treaties, if we look at the first treaty, which is India-Singapore, it defines resident as any person who is a resident of a contracting state in accordance with the taxation laws of that state. So basically, a person who is a resident of India in accordance with the laws of India is regarded as a resident for India-Singapore treaty purposes. So this is very straightforward, simple. So even a RNOR will be regarded as a resident of India from a India-Singapore tax treaty standpoint. Let's consider two more definitions, which have slight variations in the way they define resident. So first, if you look at the India-UK treaty, it defines resident as any person who, under the laws of that state, is liable to tax therein by reason of his domicile, residence, place of management, place of incorporation, etc. Provided, however, that this term does not include any person who is liable to tax in that state in respect only of income from sources in that state. So this is the UK definition. The US definition is also similarly worded, with the exception that it also includes a person who is liable to tax by reason of citizenship. So the word citizenship is missing in the UK treaty. It is present in the US treaty. Now with this, the question is, if there's a person who is a RNOR, can he claim Indian treaty benefits? Well, let's say under the India-UK treaty as well as under the India-US treaty. So if he earns, let's say, income which is taxable in UK and he's a resident of India, can he avail the India-UK treaty benefits? The key question here is he liable to tax by reason of his residence in India? And is he liable to tax only in respect of sources in India? Because if he is liable to tax only in respect of income from sources in India, he is not really a resident as per the India-UK treaty. There could be two views on this, because for a resident and not ordinarily resident individual, as we've discussed, if we look at the scope of taxable income, income which is accrued or which arises in India is taxable in his hands. But income which accrues or arises outside India is not taxable. So one can argue that RNOR is liable to tax only in respect of income from sources in India, and hence it doesn't satisfy the definition of a resident. But if we look at this particular term liable to tax in a slightly different manner, where we have precedents in the Indian context which have interpreted this to mean that even a future tax liability is covered, or a tax liability which can otherwise arise but is exempted by the state, then that is also covered. If you interpret it in that context, and given the way section 5 is worded, basically RNOR is a category of residents, and for residents all income is taxable. And then there is a proviso which says that for RNOR, income which accrues outside India is not taxable. So we can say that RNOR is also a category of individuals who are liable to tax in India, but currently there is an exemption provided to those individuals. And hence we can't really say that they are liable to tax only in respect of income from sources in India. They are subject to tax only in respect of income from sources in India, but they are liable to tax in respect of their entire income. It's a comprehensive tax liability that they have. If we view it in that manner, then RNOR will also qualify for tax treaty residence, and hence will be eligible to invoke all the India-UK treaty benefits. By corollary, if he is also regarded as a UK resident, then obviously you have to go to the tiebreaker rule and test the tiebreaker, because then you can't take the argument that because you are RNOR, you are not really a resident of India under this provision, you are a resident only of UK. That may not really work. And hence you will then have to test the individual from a tiebreaker standpoint as well. While this is the case with RNORs who are typically taxable based on their physical presence in India, exceeding, let's say, 120 days or 9 out of 10 and 729 days as the case may be, how do we look at the position of a stateless person who is deemed to be a RNOR? But in that individual's case, the deeming fiction is attached only because of his citizenship with India. It's not really based on his domicile or residence, because he may be staying in India for not even a single day, and he will still qualify as RNOR. So is the will the position then change for such an individual? I think the answer to that is yes. He may qualify as a resident under the India-US treaty, which clearly says that a person who is liable to tax on account of citizenship is also a resident of a particular state. But under the India-UK treaty, he may not really be able to invoke treaty benefits because he is not liable to tax in India on account of his domicile or residence. But this is a fairly new concept and not really tested. So I think this will be subject to some controversy at different forums. Let's take another case study, which is on split residency, where Mr. A is an Indian citizen and he leaves India and moves to the US, let's say with effect from 1st January 2022. He takes along his wife and children to the US and he intends to settle down in US. He qualifies as a US tax resident for calendar year 2022 because US follows a calendar year system. In that case, what will be his treaty residence for tax year 2021-22? Will he be an Indian resident? Will he be a US resident? How do we resolve the conflict? And will he be eligible to invoke India-US treaty benefits for these two periods, 1st April 21 to 31st December 21, and income accruing from 1st Jan 22 to 31st March 22. So this is a classic case of split residency, and in India, we don't have any provisions dealing with split residency in the Income Tax Act. But if you look at the OECD model commentary, and there are a few judicial precedents in the Indian context as well, they basically say that in this particular case, the person becomes a dual resident for the period January to March, because from an Indian tax standpoint, he qualifies as a resident for the entire financial year 21-22, and from a US perspective, he qualifies as a resident for calendar year 22. So this is the overlapping period, Jan to March 2022. So the two states need to then apply the tiebreaker rule and decide which state he breaks into. So in this case, if he has moved to US along with his wife and children, and he has a permanent home in US and so on, but not in India, then he will logically break into US, in which case, for the period Jan to March 2022, he will be regarded as a US resident, but only from a treaty standpoint, not under the Indian domestic law. Under the Indian domestic law, since we don't have any split residency provisions, he'll continue to be a resident for the entire financial year. So he will be eligible to invoke treaty benefits for 1st Jan to 31st March 22. But when it comes to taxation under the domestic law, which has nothing to do with the India-US treaty, for example, if he's earning some income from UK, then the Indian provisions will apply, the domestic law provisions will apply. Again, while there are a few precedents in the Indian context, it's not really been tested in a lot of cases. And hence, there could be some litigation if we take the position that 1st Jan to 31st March, he will be eligible to invoke treaty benefits. If we move to the next slide, this is where I've captured the OECD commentary. And if you read the OECD commentary, para 10, it clearly says that as far as possible, the preference must be of such a nature. Yeah. So if you look at the bold and underlined part, it says that the facts to which the special rules, that is the tiebreaker rules, will apply are those existing during the period when the residence of the taxpayer affects tax liability, which may be less than an entire taxable period. So in this case, the special rules, that is the tiebreaker rules, applicable only for the period 1st Jan to 31st March, which is less than the entire taxable period. The example is also similar to what we discussed. It says that, for example, in one calendar year, an individual is a resident of state A under that state's tax laws from 1st Jan to 31st March. He then moves to state B. Because the individual resides in state B for more than 183 days, he is taxed as a resident in state B for the entire year. Applying the special rules to the period 1st Jan to 31st March, he was a resident of state A. Therefore, both state A and B should treat the individual as state A resident for that period and as state B resident from 1st April to 31st December. So the OECD commentary endorses this particular view. India has made reservations to various paragraphs in the OECD commentary as well as the text. but hasn't really made any reservation to para 10 of the commentary. If you look at Spain, just for illustration, it has clearly made a reservation. It says that Spain, due to the fact that according to its internal law, the fiscal year coincides with the calendar year, and there is no possibility of concluding fiscal period by reason of the taxpayer's change of residence, will not be able to proceed in accordance with para 10 on Article 4. In this case, a mutual agreement procedure will be needed to ascertain the date from which the taxpayer will be deemed to be a resident of one of the contracting states. So Spain has made a clear reservation from application of para 10. India doesn't have such a reservation. So from an Indian perspective, given the OECD commentary, given certain favorable judicial precedents, one can explore this view and take a position that for the period, you can apply the tiebreaker test for that dual residency period. And if the individual breaks into the other country, he'll be eligible to invoke that treaty benefit. Coming to outbound assignees, because we have seen a lot of people moving from India to other countries. How does their income become taxable in India? So the primary right of taxation is always given to the country of residence of the employee. However, if the employment is exercised in another country, that country which we will refer to as the source country may also tax such income unless all the following conditions are satisfied. The first condition is that the employee is present in the source country for a period not exceeding 183 days in any 12-month period. Remuneration is paid by or on behalf of the employer who is not a resident of the source country, and remuneration is not borne by PE or fixed pay situated in the source country. So typically DPS, the Dependent Personal Services exemption and the treaty benefits are invoked in the context of inbound assignees. For example, if a US employee sends someone to India, then the DPS article will say that India, being the source country, can tax it only if the following conditions are satisfied. But even in the outbound scenario, this DPS related article becomes very important. And we will understand that with one example. So let's say Mr. X is employed with an Indian company. He is deputed to a UAE branch of the Indian company with effect from 1st April 2022. He receives part of his salary from the Indian employer in his Indian bank account. And he also receives the balance salary from the UAE branch in his UAE bank account. He is based in UAE throughout FY 22-23. So the question is, will his salary income be taxable in India? Because he is receiving the salary income in India and his employment is also with an Indian company. In this context, if we look at Article 15, which is the DPS, the Dependent Personal Services article, Article 15 para 1 says that subject to the provisions of Articles 16, 17, 18, etc., salaries derived by a resident of a contracting state in respect of an employment shall be taxable only in that state, unless the employment is exercised in the other contracting state. So here the person qualifies, an individual qualifies as a resident of UAE. So the way we will read this Article 15(1) will be salaries derived by a resident of UAE in respect of employment shall be taxable only in UAE unless the employment is exercised in India. If the employment is so exercised, the remuneration as derived therefrom may be taxed in that state, that is in India. So the key question here is whether the employment is exercised in India or in UAE, because that will determine whether the salary will be taxable in India or not. If we look at OECD model commentary, it clearly says that the place at which the employee is physically present for providing his services for which he receives salary income, that is the place where the employment is exercised, notwithstanding the fact that his employer may be situated in a different contracting state. This is also supported by commentaries of Mr. Klaus, Professor Klaus Vogel, and certain other international commentaries as well. So the preponderant view is that the place where the employee is physically present is the place where the employment is exercised. Considering this interpretation, given that he is physically present in UAE throughout FY 22-23, one can take the view that the employment is exercised only in UAE. It is not exercised in India. And hence, in this context, when a person goes outside India on, let's say, a long-term assignment, his income will not be, his salary income will not be taxable in India, even if it is received in India. I think in the course of one of the subsequent sessions, I think the DPS article will be covered in more detail. So we'll just cover the outbound scenario and we'll move to the next situation, which is taxability of independent personal services, or IPS. Now, if we look at independent personal services, this article typically connotes services rendered by individuals, because professional services are rendered by individuals. They can't be rendered by a company or a legal entity. But there is a difference in the language of certain treaties. Certain treaties specifically say that services should be rendered by individuals or a firm of individuals. Whereas some treaties say that the services can be rendered by a resident of the other state, in which case the IPS exemption can apply even to non-individuals. The services should be in the nature of a professional service or other independent activities of a similar character. Basically, it has to qualify as a professional service, which includes independent scientific, literary, artistic, educational, or teaching activities, as well as independent activities of physicians, surgeons, lawyers, engineers, architects, dentists, accountants, and so on. So any service which is rendered by a professional qualifies as a professional service, and hence is eligible for the IPS article. In order to tax independent professional services, basically at least one of the conditions should be satisfied. And the conditions are as follows. The person rendering the service should have a fixed base regularly available to him for the purpose of performing his services. So for example, if a lawyer, if is a lawyer who is based outside India, but he provides services to Indian clients as well, and he has a chamber in India from which he regularly provides advice to Indian clients, then he derives professional service fees which are connected with a fixed base regularly available to him, and hence that will become taxable in India. The other condition is that the person rendering the service should stay in India in the relevant financial year for a specified number of days, and the days can vary. In some treaties it is 183 days, in some it's 120 or 90. So if any one of these two conditions is satisfied, the professional services become taxable in India. Let's take another case study to see what kind of controversies or what kind of positions can emerge when it comes to taxing IPS. Let's say Mr. A is a resident of a foreign country. He is an engineer and he provides technical consultancy services to an Indian company. Will he be liable to tax in India? So here, basically, there's a conflict in terms of which article should be applicable, because he's providing technical consultancy services. So it can either qualify as fees for technical services, or because he's an engineer providing these services, it can also qualify as independent professional services. If you look at India's treaties, these can be broadly divided into two categories. The first category is where the FTS definition, if you look at the fees for technical services article, there's a specific exclusion for independent professional services. So for example, treaties that India has with US, UK, Canada, Finland, France, these have a specific exclusion for independent professional services. The second category is where the FTS definition does not specifically exclude IPS. The examples could be Germany, China, Cyprus. So the question is, which obviously under the first category where FTS definition specifically excludes IPS, the taxpayer doesn't have a choice. He has to be governed by IPS, which means that if he doesn't have a fixed base in India, or if he is not present in India for a particular time threshold, he doesn't satisfy the time threshold, then he will not be taxable in India. Under the second category, the question is, does he have a choice in terms of choosing which of the two, FTS or IPS, which of the two articles he can basically apply. So if we look at FTS, it may be more beneficial as compared to IPS in certain cases. For example, in some treaties like India, US, UK, there is a restrictive definition of FTS. Of course, it falls under the first category, but there may be other treaties where FTS article has a restrictive meaning and it doesn't exclude IPS from its scope. So in those cases, falling or rather choosing to be under the FTS article may be beneficial for the individual because it may not qualify as FTS and hence it may not be taxable. The other situation could be FTS is typically taxable on a gross basis, whereas IPS on a net basis. So if the gross basis taxation is lower than the net basis taxation, then FTS article could be more beneficial. On the flip side, IPS could be more beneficial if the person hasn't spent the required number of days in India or doesn't have a fixed base in India, because then automatically he goes out of the tax net. So here there are arguments for and against the view that one article is more specific and the second is general. And typically, if one article is more specific and the other is general, the specific article gets precedence over the general article. Here it's a little difficult to split the two, whether FTS is more specific or IPS is more specific. There are precedents which have held that FTS is more specific. In certain cases, it has been held that IPS is more specific. But again, if we look at the primary purpose of tax treaties and consider that it's to be interpreted liberally to keep the spirit in mind, then basically the taxpayer has a choice to either be governed by the FTS article or the IPS article. And there are a number of case laws also supporting this view that if multiple articles of the treaty cover a particular stream of income, then the taxpayer can choose which article he fits into. So in the second category of treaties like Germany, China, Cyprus, and others, the taxpayer can very well decide whether he wants to be governed by the FTS definition or whether he wants to be governed by the IPS article, depending on whichever is favorable to him. And accordingly, consider the taxability in that case. So I think we are at the end of our session. I'll be happy to take up questions from the audience. I can see that there are a few questions in the chat box.
Yeah, we have some questions in question and answer chat box, and some are, I think, in chat box itself.
Right.
So I request all the participants to please put your questions in question and answer box so that we can chronologically cover one by one.
Right. So one question we have in Q&A is that a person is given assignment for providing water treatment outside India, that is in South Africa, and professional fees is credited to Indian account. Whether his income is taxable in India, he is a director in a private limited company in India and doing business from South Africa. Any effect on his director remuneration he receives from his private its company, and what about income of his private limited company? So there are three questions into that.
Okay. So yeah, I can see the question. I think the important thing to evaluate is whether this person qualifies as a resident of India or South Africa. If he qualifies as a resident of India, then obviously his global income will be taxable in India. If he qualifies as a resident of South Africa, then we will have to look at the India-South Africa treaty. Professional fees credited to Indian account. So again, whether it fits into IPS article or whether we have to evaluate taxability under the FTS article, that is something that we'll have to evaluate. And depending on the category of the treaty, whether he can choose to be governed by FTS, what's the scope of FTS under the India-South Africa treaty, does it have a restrictive language? I think all those questions need to be evaluated in order to answer this particular question. So in a typical case, if it's, let's assume that he qualifies as a resident of South Africa and it's not an income which can fit into the IPS article, then typically it will qualify as FTS. I'm assuming that he's giving a consultancy fee. He's getting a consultancy fee from the Indian company. So in that case, it will be taxable in India. Water treatment outside India, again, the source rule exclusion. I mean, is this a business which is being carried on outside India by the Indian company for which the services are being utilized? That's also a question to be asked. And depending on that, whether the source rule exclusion under the Indian domestic law can apply, that is also something to be evaluated.
Ruta madam, you want to ask something?
Yeah. I actually wanted to ask Umesh, Rohan sir, regarding this particular case of water treatment only, just because I had also a similar question in mind, that here the person is resident in India, let's presume this, but the actual service is given outside India. In such a case, then as you rightly said, it is the global income which is taxable, right? So
Correct.
here the PE doesn't matter. Is that the case, or where the place of giving the service also doesn't matter?
Correct.
That is what my confusion is, that place doesn't matter where I'm giving the service, and the fact that if I have a branch office in, say, South Africa, whether it will make a difference for my taxation.
No, it won't make a difference for your taxation if you're a
Okay.
resident of India, because the scope of taxable income includes global income for resident. I'm assuming it's a ROR situation, in which case global income becomes taxable. So
the private limited company might be essentially a residential company, and if I have a branch office in, say, South Africa, and I'm rendering the services also in South Africa, but getting income here. So I think, I mean, that is the point where, things start getting confusing.
Yeah, I think the key question is the individual's residential status, whether he's a resident or a non-resident. If he's a resident of India, then
the question doesn't arise.
Yeah, then global income becomes taxable. If he's a non-resident, then whether he can invoke the India-South Africa treaty, it can be invoked only if he's a resident of South Africa. If he doesn't qualify as a resident of South Africa, then again the treaty goes out of the picture. Then you have to only look at the source rule exclusion to see if you can fit his case in that source rule exclusion. So if it's a service which is utilized in the branch.
So ultimately residence is the issue, right?
Correct.
Thanks.
Yeah.
Pranav,
Yes, sir.
can you read second question?
Yes. The question is, how do we choose the beneficial provision of tax treaties by taking certificate from IT authority?
Yeah, so you don't need any certificate for choosing the beneficial provision. You can apply it on your own. Basically, to invoke treaty benefits, you will need a tax residence certificate from your home country. So if a person is a resident of, let's say, US, he'll need a TRC from the US tax authorities, and that will need to be provided to the Indian payer if the Indian payer is wanting to give treaty benefits to the US resident from a 195 perspective. So there are certain other documents also, so Form 10F and all of those requirements also have to be met. But you don't need a certificate from any income tax authority to claim treaty benefits.
True. Another question is, for residential status, what about the Indian citizen who leaves India as a member of crew of a foreign ship, whether a 60 days or 182 days criteria will apply?
Yeah, so if he is leaving as a crew member of an Indian ship, it's 182 days. But again, that is only for the first year.
So they are asking about the foreign ship. So he's a member of a crew of a foreign ship.
Of a foreign ship. Okay.
Of a foreign ship.
So for foreign ship, there is no problem. I mean, if he's taking up employment with the foreign shipping agency, then obviously he's going outside India for the purpose of employment. In which case, again, the 182-day rule will apply.
Right. And what about the taxability of NRE interest from Indian bank in case of RNOR?
NRE interest is exempt. I'll have to evaluate. I haven't evaluated this. I can check and come back to you on this.
Sure. Then meaning of country of source and a country of residence and meaning of contracting state. So I think more from a treaty perspective, I think if you can just elaborate in a short thing, and probably
Sure.
it might help.
Yeah, so basically contracting states are both. The country of residence is one of the contracting states and the country of source is the other contracting state. And the treaty basically allocates income, taxation rights between these two contracting states, the country of residence and the country of source. And in certain cases, the treaty provides that the country of source will not tax a particular income, or it provides that the tax rate will be restricted to, let's say, 10% and so on. So if you take out any treaty, let's say the old India-Mauritius treaty, then India as a source state was not allowed to tax capital gains derived by a resident of Mauritius. So that was a allocation of taxing rights. It was allocated only to Mauritius, not to India at all, in terms of taxation of capital gains. If you look at, let's say, royalty or FTS income, which is paid by an Indian resident to, let's say, a Portuguese resident, then the India-Portugal treaty says that it will be taxable only at 10%. So this is how either the tax treaty rate gets restricted for the source state, or the allocation of taxing rights itself is restricted from a source state perspective. And from a resident state perspective, given that the primary right of taxing a resident is with the country of residence, they get to tax all the income which is derived by a resident. But the treaty provides that the country of residence will give a tax credit. If the source country is allowed in terms of the treaty to levy tax on the income of a resident, then the resident state, the country of residence, will give a tax credit. So if India levies a 10% tax on royalties, then that 10% becomes creditable against the home country or the residence country taxation in accordance with the rules which are specified in the treaty. Or if again the domestic law of the residence country, they are more beneficial, then those rules can be applied.
One question is in terms of 15 CACB. So just for the knowledge of the participants, we do have a different session or entire session on 15 CACB practical issues. But if you can just guide us on. The question is purchase of immovable property from non-resident, where payment of purchase of property is done in INR. So do we need to file 15 CA and CB? If yes, then how to fill form 15 CB, which AD category bank is to be used?
Yeah, so basically 15 CACB is to be filed if there is a remittance which is chargeable to us in India. When practically, if you're making any remittance to a non-resident, your bankers will require you to file form 15 CACB. In this case, I mean, it's not clear from the question whether this immovable property is situated in India or it's situated outside India. It's not very clear. Assuming it's an Indian immovable property, the non-resident will basically be taxable in India, right, because it will not be relieved under the domestic law. There will be no relief under the treaty also typically, in which case the payment becomes taxable under 195 and all the compliances need to be done. So 15 CACB, both the forms will become applicable. I'm not sure about this question, which bank AD category. I didn't quite understand the question.
Probably the formalities of part of 15 CB. I think the question must be added, but we will definitely park this question for the session which is going to happen on 15 CACB.
Sure.
So probably we can just answer that.
Sure.
Then another question is in case of taking the beneficiary DTA, please list Form 10F and self-declaration for non-P India is enough. So I think the question is little unclear, I feel.
You'll basically need the tax residence certificate as well along with these, because if the TRC is issued in the home country, but you haven't taken it, then the concessional tax rate may not be applicable. So TRC, Form 10F and declaration or other documents that you need in order to grant treaty benefits, all those documents should be kept on record as a payer.
Then what rate is to be applied for dividend income of non-resident from Indian company? Will it be 20% or as per the tax slabs?
Right. So it will be 20%, basically, because that's the rate that is provided from a withholding tax standpoint. It can even be lower depending on the treaty rate. So if the non-resident is a resident of a foreign country with which India has a tax treaty, and the treaty provides for a 5% or a 10% tax rate, then that tax rate can be applied if the individual gives necessary documents, such as TRC, etc., again, to the dividend paying company.
Right. Another question is charges paid to foreign bank for services rendered outside India, and the services provided by foreign bank is not connected with any PE in India, whether withholding tax is applicable.
So this withholding tax should not apply in this case, because it's as long as it is not qualifying as interest. So what we have to evaluate is whether this qualifies as interest. If it doesn't qualify as interest, then it would typically be business income for the bank. And if the bank doesn't have a permanent establishment in India, then withholding tax should not apply.
Of course.
So interest definition is also different in different tax treaties. If these are processing fees in connection with a loan, whether it qualifies as interest under that treaty, if these are guarantee fees, what exactly is the nature of the charges? That is something that you have to evaluate in order to determine whether this is interest or not. That's the key question. If it's not interest, business income, no PE, it should not be taxable.
True. In case a person is having a salary income from Kuwait, the tax is not charged in that country, then what is the taxability of income transferred to Indian bank account?
Yeah, so as we discussed, the first receipt is important. So if you have salary income in Kuwait and the income is also credited to your Kuwait bank account first, and then it is remitted to India, that subsequent remittance doesn't give rise to taxation in India. So this salary income will not be taxable in India. Okay. I'm assuming you qualify as RNOR at least.
RNOR, right. And the follow-up question for that is whether he is required to report his salary income from Kuwait in ITR.
So not really. I mean, it's not really in the scope of taxable income at all in India. If you are a RNOR, you don't need to report your income which is earned outside India.
So there is a request from member that can you kindly elaborate upon the taxation of seafarers from residential status perspective?
It's like any other taxpayer. So you have to basically look at the physical presence in India. If the physical presence crosses the number of days that are prescribed, then you will qualify as resident, ROR, RNOR, as the case may be. I mean, there is no exception for any particular category. It's basically uniform across the board.
If Form 67 is not filed within the time by the individual in India, then is there any way out to get the double taxation benefit?
I mean, it's not the most ideal way to get tax credits, but yes, I think there are a few precedents in which it has been held that this is only a procedural formality, and even a delayed filing should be okay to claim tax credit.
Okay. Then Mr. X goes to South Africa for providing engineering services. He stays in India for more than 182 days in India. And what procedure we follow if South Africa deduct tax on his income earned in South Africa?
Mr. X goes to South Africa for engineering services. Yeah, so he's basically a resident of India. And assuming South African payer has deducted correct taxes as per the India-South Africa treaty, then basically in his Indian tax return, he can claim a credit for the taxes that have been paid. This Form 67 will have to be filed. Yeah.
Right. How to know whether India has a treaty with any other country?
So this is available on the Finance Department's website. There's a list of all the treaties that India has entered into. So if you go to the incometaxindia.gov.in website, you'll get a complete list of all tax treaties that India has entered into.
Then whether TRC is required if withholding tax is done as per section 195 and no treaty benefit is taken, undertaking from vendor with respect to his residential status, will that be enough?
If you're not claiming 20 benefits, then TRC is
It is
not
not.
required. But why do you then need his residential status undertaking? I'm not very clear on the question. I think even from a 206 AA perspective, it's always ideal that you have the TRC, because one of the conditions for relaxation is that the TRC is opted. So it's ideal to get the TRC from this payee.
Right. In case of seafarer, if he is not a resident of any country, whether he'll be covered under the deemed residential status. He's not
If he's a
resident of-
citizen of India, assuming he's a citizen of India, he will be covered. He'll be RNY, basically,
He'll be
under section 61A. But it doesn't apply to persons of Indian origin. He has to be a citizen of India.
Correct, correct. Another question is, in case of immovable property transaction, if buyer and seller both are NRI, then whether they are required to deduct tax on that transaction.
So
So probably we'll presume that property is in India only.
yeah, if the property is in India and you're paying tax, so under 195, the status of the payer is not really defined. The payee has to be a non-resident, and there's a controversy on whether the 195 provisions will apply to non-residents, non-resident payers. And the view there is that, and this is also based on certain judicial precedents. The view is that 195 should not have extraterritorial operation, but if there is a reasonable nexus with India, let's say in the form of a PE, or in this case even immovable property, then ideally 195 will be applicable. And even if it's a NR to NR transaction, there will be an obligation to deduct tax under 195.
Right. So I'll just find out if there are any questions in chat box also. There are a couple of questions. 15 CA or CB applicable if TDS paid on gross amount. So I think
Not clear on the question.
not clear on the question. Then what are the consequences of rental income, FD interest, etc. not disclosed by US citizen in US tax returns? How USA tax department can have access or information about this?
Don't think that's connected with the session. I think they'll have access probably.
They will have. Mr. X goes to South Africa. I think we have covered this question. Then TRC available. Whether TRC available for completed year only or for running year also. Not clear about. I think whether TRC available for completed year only or for running year also. That is the question.
Yeah, so I think the situation is where you want to make a remittance today, and the TR. I mean, in some countries they issue a TRC on a provisional basis as well. So that is one document that you can keep, or you can keep the TRC for the earlier year, and as soon as the TRC for this current calendar year can be issued by the home country, you should keep that as well on record.
Sure. So if there are any specific questions, then probably we request the participants to put it in the Q&A box so that we can take up those. I think we have covered all the questions, whatever has been there. Yes, one question is whether NRE FD interest is to be included in 15 lakhs limit.
NREFT, I mean, NREFT is not taxable, right? In any case, it's not part of total income.
Then what is the process to obtain TRC in India?
We have to apply to the assessing officer to get a TRC. There's a specific form that has been prescribed, and I mean, it should be easy to get TRC in that case.
So I think in case of marketing fees paid by credit card, whether 15 CACB is required.
Marketing fees paid by
Credit card. So credit card payments has the marketing fees are typically paid by the from credit card transaction. Whether still 15 CACB will be required.
okay, that way. I haven't seen anyone issuing 15 CACB for that, but yeah, I mean, if it's a payment to a non-resident, the act doesn't really distinguish on the based on the payment mode. If it's a payment made to a non-resident, you have to file form 15 CACB.
But the practical challenge is there is the withholding tax will not happen because the transaction doesn't get executed. If we want to pay the through the credit card, the full amount has to be remitted. So in that case, the withholding tax, if
Yeah,
there
it
are
may not
any,
even be taxable, but even if it's not taxable, you have to report it in 15 CA.
right.
Typically, marketing fees, in case they don't qualify as
FTS.
then they'll not be taxable in India.
Then one question is, can interplay between domestic law and DTA be used for every year differently, depending on what is beneficial for that year?
Yes, absolutely.
Is link payment, is link Singapore payment outside India chargeable to tax in India under Section 195?
Sorry, which payment?
Is linked Singapore payment a payment outside India chargeable to tax in India under 195?
I'm not clear on the
Yeah,
you
the
mean the
question.
linked Singapore payment?
Then whether we have to deduct tax under 195 if we pay fees or charges for purchase of extra space of Google Drive for any book or any software that we purchase, and to pay to foreign company in credit card or through net banking. So typically, I think we are more talking about the extra space of Google Drive being purchased and any book or software that is being purchased and the payment has been made in a credit card by the foreign company. So whether 195 TDS will be applicable.
Right. So I think this will be covered in the royalty FTA session, but typically if it's a software licensing agreement, then as per the Supreme Court decision engineering analysis, it will not be taxable in India.
Okay. So the earlier question, what it was referred to, the clarification is that whether the LinkedIn Singapore payment, whether it will be chargeable to tax under 195.
LinkedIn, so subscription fees.
Subscription fees.
Yeah, it should not be taxable again. It will not qualify as royalty FTS. It will be business income. So if you don't have a PE in India, it should not be taxable in India.
Right. And whether withholding tax will be applicable for commission paid to UAE resident.
Commission paid to UAE resident. So commission, I'm assuming it's export commission. And for that, there are a lot of precedents which say that even under the Indian domestic law, in most of the cases, it doesn't qualify as FTS. But if you look at the India-UAE treaty, assuming this particular person is eligible for invoking India-UAE treaty, there's no FTS article in India-UAE treaty. So again, under the treaty as well, it should not be taxable in India.
So last question, I think it's foreign company has ESOP given to his employee, and this employee is sold by the employee after 2 years. Whether it is required to be reported in ITR and what tax rate will be applicable.
Yeah, so I think there's a session on ESOP taxation, but I'll address this question very briefly. Foreign company has given ESOP to employee. So I'm assuming the employee is a resident of India. This ESOP is sold by the employee after 2 years. So basically the way ESOP taxation works is once you exercise the ESOP, the difference between the exercise price and the fair value is taxable as salary. And after that, once you get the shares, you sell the shares, those gains are taxable as capital gains. Depending on the period of holding, it will either be short-term capital gains or long-term capital gains. In any case, all of this has to be reported in the ITR. If it's salary income, it'll 192 TDS has to be done by your employer. If it's capital gains, you have to pay capital gains tax and report it in your return of income.
True. The other question, the earlier question regarding this Google Drive space. So the reply is not clear. That's what the member is saying.
Yeah. So,
So
under
whether
yeah.
Yeah, so 195 whether still will be applicable for the Google Drive space that is being purchased.
Yeah, it should not apply because it's not really, I mean, it will not fit in the royalty definition because you won't have, you're just using a standard service. So it's not FTS and it's not royalty, in which case it should not be taxable in India.
Right. And one clarification regarding this LinkedIn Singapore, the member is asking, what if the LinkedIn has a tax entity in India, but they are billing only on Singapore entity? Then how do we look at 195 taxability?
Yeah, I mean, irrespective of the fact whether they have an entity in India, what's the privity of contract? I mean, who are you contractually entering into a relationship with? If your subscription is with the Singapore company, then you have to look at the Singapore company's taxability. The Indian company can be a marketing arm. Doesn't necessarily mean that they'll enter into contracts with the customer. So you'll have to look at your contractual relationship. If you're contracting with the Singapore company, is the Singapore company eligible to invoke treaty benefits? And then what's the evaluation under the treaty? Typically, subscription fees will not be taxable under the Singapore treaty.
Okay. One question on withholding tax is that bank of my client is asking for Form 15 CACB, as my client is private limited company and is engaged in the business of tour and travel. He arranges travel for Haji Yatra. Indian company want to send money abroad to UAE for hotel booking and other expenses to one of their director for arranging the Haji Yatris. Bank asking for Form 15 CACB. My question is, TDS required to be deducted for such payment sent abroad?
So this is basically for booking hotels, right? Hotels and other expenses.
Other expenses.
So this will not be taxable in India because all these arrangements are being made outside India. And I'm assuming the income is earned by a non-resident based out of Saudi Arabia. So in which case, this will not be taxable. But as I said, practically banks do ask for Form 15 CACB for all remittances which are going outside India. So you'll have to give those forms to them to process the remittance. Technically not required. You can fill Part D, but banks don't agree with that view.
So I think we have covered, I think we have got all the questions, I feel. So there are no specific questions in the Q&A chat box. That was the last question, I feel. Okay, so probably if there are any more specific questions, then probably we can get back to CA Rohan so that he can answer through probably email or something, and then all those queries can be redressed. But thank you so much, CA Rohan, for giving the wonderful session and various practical aspects and the intricacies of this very complex topic. These are the what I would say the very hardcore sections of the international taxation, which has been appropriately deliberated. So we once again thank you on behalf of Pune branch for having such excellent session.
Thank you. Thank you.
Pranav,
Yes.
I must say the way Rohan sir covered the topic given today, case studies, it is very, very practical oriented.
Right.
He, just in half an hour, he covered sections, and
Correct.
after that, he has covered all the case studies.
Absolutely.
Which is very, very important because sections, by the way, it is available in BEAR Act. But the way he has covered all the case studies, it is really, really excellent. Thank you, sir. Thank you for spending your valuable time and enlightening us on the important topic of the series. On behalf of Pune branch and all the participants, I really thank you. Pranav will give formal note of thanks regarding the recording, definitely I just like to convey my all participants. We are trying to give a recording to all the participants only. We will not upload this recording on YouTube, but we will definitely trying to provide this to all the participants.
Yes. And one more, of course, with the permission of the faculty, if you can just allow us, then probably we can share the presentation on Pune website. That can be uploaded. Of course, if CA Rohan sir gives us the permission, so we'll definitely upload the presentation on the Pune website.
Sure, that is fine. I'll share
Yes.
my contact details as well, because I can see a few people
Yes, yes.
wanting the contact details. So I'll share the presentation with the contact details with all of you.
Right.
And thank you so much. Thank you to all the participants for a patient listening and making it very interactive. And thank you to the Pune branch for inviting me to speak on this topic. Thank you so much.
Thank you. Thank you so
sir.
much.
Thank you.
Thank you. Thank you so much. It's indeed a pleasure for us to listen to you. And
Thank you.
thank you. Thank you so much. And we'll wish to have many more sessions on this topic as well as on the another topics also.
Definitely.
Surely. And I'm also thankful to all the participants for such patient listening and the wonderful questions that has come up. So it has actually what I would say has an excellent discussion, what I would say, on this very complex topic. So
Very
thank you all.
participation. Pranav, very active participation.
Very active participation. Absolutely. Yes. Thank you so much all.
Thank you so much. Thank you.
Yes. Thank you. Bye.